When Milan's banks looked away, it did not begin with losses or panic, but with silence. Decisions went unchallenged. Warnings were softened. And inside Milan's banking corridors, attention slowly drifted elsewhere. The danger was not what was done. It was what was ignored. To understand why this mattered, we need to look at a system shaped by familiarity. Italian banks had lived through crises before. They knew how to survive turbulence. Over time, that experience bred confidence. Not reckless confidence, but fatigue. The belief that risks would reveal themselves early, loudly, and unmistakably. That belief still echoes whenever institutions assume they will see trouble coming. The story begins with portfolios that look stable on the surface. Exposure was spread. Capital met requirements. Non-performing loans were monitored closely, reduced methodically from past peaks. On paper, progress was real. Milan's banks appeared healthier, leaner, and more disciplined than they had been in years. But beneath the numbers, incentives were shifting. Growth was slow. Margins were thin. Pressure to support local businesses remained strong. Credit decisions became relational rather than analytical. Loans were renewed, extended, restructured, not because they were strong, but because confronting weakness felt premature. Early signals appeared quietly. Cash flow softened. Collateral value stagnated. Extensions became routine. None of it breached thresholds. None of it forced action. The system continued, reassured by the absence of alarm. Inside risk departments, unease surfaced but rarely escalated. Models flagged deterioration, yet outcomes lagged. Defaults did not spike. Employment held. The evidence supported patience, and patience became policy. What Milan's banks were doing was not reckless. It was human. When stress does not punish immediately, it becomes easier to look past it. Attention shifts toward survival rather than correction. Risks remain, but they are no longer urgent. By the time anyone questioned the silence, it had already shaped behavior, and looking away, even briefly, can be enough to let vulnerability settle into the foundations. Milan's banks had not failed. They had paused their scrutiny, and that pause would soon demand a reckoning. The silence persisted because nothing forced it to break. Loans continued to perform, at least technically. Payments arrived, sometimes late, sometimes adjusted, but rarely missed entirely. Each accommodation felt justified. Supporting borrowers preserved relationships. Preserving relationships protected balance sheets. The logic was circular, and it was comforting. Inside lending committees, decisions leaned toward continuity. Restructuring replaced resolution. Temporary measures extended indefinitely. Loss recognition was delayed not through deception, but through hope that conditions would improve before recognition became necessary. When survival depends on timing, optimism becomes policy. Risk indicators continue to flicker at low intensity. Concentrations grew in specific sectors tied closely to regional economies. Small and mid-sized firms depended on bank forbearance to remain operational. Banks depended on those firms to avoid crystallizing losses. The relationship deepened into dependency. Regulators observed the pattern with caution. After years of forcing balance sheets to clean up, they were reluctant to provoke another wave of distress. Stability, even fragile stability, felt preferable to disruption. Oversight softened, not officially, but in emphasis. The system was healing, and no one wanted to reopen wounds. Markets reinforced the quiet. Spreads remained contained. Funding stayed accessible. There was no external pressure demanding confrontation. Milan's banks appeared stable enough to justify patience. And patience, once normalized, became inertia. Inside institutions, younger risk officers noticed the drift more clearly. They saw that exposures were not improving. They were aging. Asset quality depended increasingly on extensions rather than recovery. But challenging the approach required authority, and authority was anchored in experience that remembered worse outcomes. The danger was not hidden losses alone. It was erosion of discipline. When standards bend repeatedly without consequence, they reset. What had once been exceptional became routine. What had once required escalation now required justification to change. By looking away from incremental deterioration, Milan's banks preserved calm, but calm built on deferral has a cost. It accumulates quietly, compounding until recognition can no longer be postponed. The system was still standing, yet beneath its stability, pressure was rising, waiting for the moment when silence would no longer be an option. The reckoning arrived not through a sudden shock, but through accumulation reaching its limit. A sector-wide slowdown tightened cash flows just enough to expose how many borrowers were surviving on extensions alone. What had been manageable in isolation became visible in aggregate. The silence broke, not with panic, but with realization. Inside banks, overdue restructurings converged. Loans once considered recoverable required fresh concessions simultaneously. Capital buffers absorbed the first wave, but projections shifted quickly. Losses that had been deferred now demanded recognition. The cost of patience arrived all at once. Regulators responded with sharper scrutiny. Reviews intensified. Classifications were challenged. Assumptions that had gone unquestioned for years were revisited under stress. What emerged was not fraud or collapse, but erosion. Asset quality had not improved. It had been maintained through accommodation. Markets adjusted rapidly. Funding costs edged upward. Investor confidence thinned. Milan's banks were still solvent, but credibility weakened. The question was no longer whether losses existed, but whether institutions had delayed addressing them for too long. Inside boardrooms, the tone changed. What had once been framed as support now appeared as avoidance. Decisions made to preserve stability were reinterpreted as postponement. The line between prudence and denial became uncomfortably clear. Employees felt the shift immediately. Risk departments regained authority. Lending standards tightened abruptly. Credit availability contracted not because the economy demanded it, but because accumulated deferral left no room for gradual adjustment. The correction, once delayed, arrived compressed. The irony was stark. By avoiding earlier pain, the system created larger disruption later. What could have been absorbed slowly now required decisive action. Silence had preserved calm, but it had also removed flexibility. Milan's banks confronted a truth few institutions welcome. Looking away does not eliminate risk. It reshapes how and when it returns. And when it returns after long neglect, it demands attention all at once. The question was no longer how the silence formed. It was how much it would cost to break it. The response was firm but measured. Italian authorities pushed for accelerated cleanup without triggering panic. Losses were recognized. Portfolios were reclassified. Secondary markets were activated to absorb distressed assets that had lingered too long on balance sheets. The silence was replaced not with alarm, but with action. Banks adjusted painfully but decisively. Capital was rebuilt. Governance tightened. Lending standards reset to reflect reality rather than hope. The process was disruptive, yet clarifying. What had been uncertain for years became visible within months. Confidence did not collapse. It recalibrated. The broader lesson reached beyond Milan. Stability maintained through avoidance is temporary. Discipline deferred does not disappear. It compounds. Financial systems require confrontation, not only with crisis, but with discomfort. Waiting for proof often guarantees higher cost. Italy's banks did not fail because they looked away. They paid a price because they looked away too long. Once attention returned, recovery became possible, but only after flexibility had been sacrificed. Europe absorbed the warning quietly. Oversight sharpened elsewhere. Forbearance was re-examined. Silence itself became a risk indicator. Not every danger announces itself loudly. Some arrived disguised as calm. When Milan's banks looked away, they bought time. When they finally looked back, they paid for it. The difference between those moments defined the outcome. So what do you think? Are we repeating the same mistake again? When Milan